Hello friends, welcome you all. In this lecture we are going to discuss about the futures of top mutual funds. In the subject of mutual fund business in India, you have done the what is mutual fund, its type, the schemes of mutual funds, and many more things you have learned. In this lecture, we are going to discuss the what are the features of top mutual funds, how to select the mutual fund, and in case if you are advisor, mutual fund advisor, then on which criteria you should suggest the mutual fund for client. That is the important thing, and these criterias or characteristics or features we are going to discuss in this lecture. Before that, just have a look the definition of mutual fund. What is mutual fund? In a simple word, we can say a mutual fund is a company that pulls money from many investors and invest in money in securities such as stocks, bonds, and short-term debts. Depend on the goal and objective of the mutual fund investment. The combined holding of the mutual fund are known as its portfolio. Investor buy shares in mutual funds, that is the in the form of units, and each unit represents investors part of ownership in that fund and whatever the income it generates. Formal definition says that a mutual fund is a professionally managed investment schemes usually run by an asset management company that brings together a group of people and invest their money in the stocks, bonds, and other securities. So in a simple word, we can say that the mutual fund is uh, the people where come together and give their small contribution for a large investment, and whatever the income that large investment or asset under management generates, it distributed among the investors who have invested contributed in the asset under management according to their contribution. So generally, the in the case of other investment, it suppose in if investor investing in the stock market, then share represents its ownership. But in case of mutual fund, units represents its ownership. Uh, Now let us discuss. There is always a problem in the selecting of good mutual fund or the criterias to select the mutual fund. If you are advisor of mutual fund, then some characteristics or some criterias of scheme selections you have to keep in mind while suggesting mutual fund to the clients. A diversified portfolio of high performing mutual funds can provide an investor with an excellent vehicle for accumulating wealth, and there are thousands of possibilities choose from, and there are so many fund schemes are there in the market. So selecting the proper fund to invest in can be an overwhelming task, and it is always a difficult task. Fortunately, there are certain characteristics and certain features that the best performing funds seem to share, and the characteristics they have, it helps to uh, mutual fund advisor or investor to select mutual fund schemes basis on that. So, using a list of basic characteristics as a way of filtering or paring down the massive list of all possible funds available for consideration can greatly simplify the task of fund selection, as well as increase the probability that an investor's choice become profitable. So let us discuss first characteristics of good mutual fund, that is low fees or expenses. Mutual funds with relatively first try to understand that every mutual fund investor have to pay some charges, like we pay brokerages in the stock market, like that. In the mutual fund we called it load, and that is exit load or entry load. So low expenses, low fees or low loads is always desirable. Mutual funds with relatively low expense ratios are generally always desirable, and low expenses do not mean low performance. Generally, we keep in mind that the high performing mutual funds charge high load, but the thing is not like that. In fact, it is very often the case that the best performing funds in a given category are among those that offer expense ratios below the category average. So there are some funds that charge substantially higher than average fees and justify the higher fees by pointing to the fund's performance. But the truth is, there is very little genuine justification for any mutual fund having an expense ratio much over 1%. Uh, in case of Indian mutual fund industry, you will find that the SEBI have given the order that if you exit after 1 year, means if you switch off your investment after 1 year, then you do not have to pay exit load. This is according to SEBI, Security and Exchange Board of India. Mutual fund investors sometimes fail to understand how big a difference even a relatively small percent increase in fund expenses can make in the investor's bottom line profitability. So here the cost or expenses or fees can make the difference in your earning profits. For example, a fund with a 1% expense ratio charges an investor with $10,000 invested in the fund $100 annually. If the fund generates a 4% profit for the year, then that $100 charge takes away a full 25% of the investor's profit. You can imagine here that 1% expense ratio, if fund generates 4% profit, then 25% is wiped out by this 1% expense ratio. If the expense ratio is 2%, it takes half of the profit, but an expense ratio of 0.25% only takes 6% of the investor's total profit. So here low fees and expenses are very important. In short, expenses are of critical importance for the mutual fund investors who should be diligent in seeking out funds with low expense ratios. In addition to the basic operating expenses charged by all funds, some funds charge a load or a sell fee that can run as high 6% to X%. It is depending on the country to country, but in India, these expenses or fees are according to the SEBI, Security and Exchange Board of India. So there is no need for mutual fund investor to ever have to pay these additional fees, since there are plenty of perfectly good fund to choose from that are no load funds and do not charge any 12b minus 1 fees. uh, there are so many funds which charge very low exit load. and they offer a good performance, or they offer good returns for the investors. So investors should always think about the expenses, fees they have to pay, load they have to bear. And those who are going to advise mutual fund, they should choose such a mutual fund which gives the good returns to the mutual fund investors, and have low expenses. Second characteristics, we can say that the consistently good performance. Most investors utilize investing in mutual funds as part of their retirement planning. Therefore, investors should select a fund based on its long-term performance, not on the fact that it had 1 year great year. So, investor advisor, mutual fund investor advisor always select such a fund that will generate good returns in the long term, not in a 1 year or in a short term period. So, mutual fund investor also choose such a fund which which have given good returns over the long period of time. A fund's average consistent performance by the fund's manager or managers over a long period of time indicate the fund will likely pay off well for an investor in the long run. A fund average return on investment, that is ROI, over a period of 20 years is more important than its 1 year or 3 year performance. So always invest mutual fund advisor should look at the point ROI, the ratio which indicate the performance of mutual fund, and investor also think about the long run returns, long run performance of the mutual fund. The best funds may not produce the highest return in any 1 year, but consistently produce good solid returns over time. It helps a fund has been around long enough for investors to see how well it manages during bear market cycle. Means in a um, bearish market, that is in a slowdown market, how it performs, that is important from the viewpoint of mutual fund. The best funds are able to minimize losses during difficult economic periods or cyclical industry downturns. A large part of consistently a good performance is having a good fund manager. Investors should review a fund manager's background also. Means when mutual fund advisor chooses mutual fund, he or she also study the background of mutual fund manager, its previous experience and performance as part of their overall evaluation of the funds. For example, take the example of SBI focused equity fund. So Mr. R. Srinivasan is the fund manager of these mutual funds since May 2009, and he has an experience of more than 25 years in the equities, having worked with Future Capital Holding, Principal PNB, Blackstone, such as then Motilal Oswal, etc. So the background of mutual fund manager is also important, and mutual fund advisor and mutual fund investor also study that things. If we take the example of SBI Blue Chip Mutual Fund, then Sohini Andani, she is the fund manager of this SBI Blue Chip Fund, and before that, Sohini Andani have worked with the ING investment, and many prestigious investment firms like Crisil, she has worked with. And in 2007, she became the research head of the SBI Blue Chip Mutual Fund, and later on in 2010, she became a portfolio manager of SBI Mutual Fund scheme, that is SBI Blue Chip Fund. So, in a nutshell, we can say that the background of fund manager is also important from the viewpoint of the mutual fund advisor and investor also. Good investment managers do not easily suddenly go bad, nor do poor investment managers tend to suddenly become a overachievers. So this thing you should keep in the mind while selecting mutual fund. Let us move towards the third characteristics of the good mutual fund. The best performing funds perform well because they are directed by a good investment strategy. So, solid strategy is important from the viewpoint of mutual fund. Investors should be clearly aware of funds investment objectives and the strategy the fund manager uses to achieve that objective. For example, take the SBI Blue Chip Fund. Here, where a fund manager is going to invest, what is the portfolio of that particular scheme? What is the investment strategy? What is the investment plan, and what are the objectives of that particular scheme or mutual fund? Should study by the investor, mutual fund investor, and mutual fund advisor also. Be wary of what is commonly called portfolio drift. What is portfolio drift? This occurs when the fund manager drifts, of course, from the fund's stated investment goals and strategy in such a way that the composition of the mutual fund's portfolio changes significantly from its original goals. Means, suppose take the example of ICICI Blue Chip Fund. Suppose if the investment objective of this scheme is it will invest in the blue chip companies or large cap companies, and if suddenly it changes its strategy from the large cap to small cap, then it is called portfolio drift. So portfolio drifts is not desirable, and the mutual fund advisor always should think about the portfolio drift, and investor also think about portfolio drift. For example, it may shift from being a fund that invests in large cap stocks that pay above average dividend to being a fund mainly invest in small cap stocks that offer little or no dividend at all. So this is the example of portfolio drift, and portfolio drift is not desirable. If a fund's invest strategy changes, the change and the reason for it should be clearly explained to fund shareholders by the fund manager. Suppose if something changes there in the strategy of investment, then fund manager should clearly explain why this strategy of investment changed from previous one. So fund manager should always explain all the things why he or she is changing the investment strategy and diverting from the investment goals. That is portfolio drift. So it all should be clear to the investors. Mutual fund advisor always think about this portfolio drift kind of things. Fourth characteristics, we can say that the trustworthy with solid reputation. So this is the important characteristics of good mutual fund. The best funds are perennially developed by well established trustworthy names in the mutual fund business. With all the fortunate investing scandals over the past 20 years, Investors are well advised to do business only with firms in which they have the utmost confidence in regard to honesty and fiscal responsibility. So investor always choose such a fund which is trustworthy and with solid reputation, the market reputation it should have. And mutual fund advisor also suggests such a mutual fund to the client that have a trustworthy and with the reputation, good reputation in the market. The best mutual funds are invariably offered by companies that are transparent and upfront about their fees and operations, and they do not try to hide information from potential investors or in any way mislead them. Uh, the mutual fund which offer all types of information or information update to the investors and the clients, so that are the transparent and which are trustworthy mutual funds. So this characteristics is important because finally the goal of a mutual fund is to generate a good return to the mutual fund investors, and it is the responsibility of mutual fund company, mutual fund schemes or mutual fund manager to provide a good return to the mutual fund investors. Next characteristics is plenty of assets but not too much money. What is the meaning of this? Means there is a plenty of asset but not too much money, which will become difficult to manage for the mutual fund manager. The best funds the best performing mutual funds tend to be those that are widely invested in but fall short of being the funds with the very highest amount of total assets. When funds perform well, they attract additional investors and are able to expand their investment asset base. So when a mutual fund perform well, they attract so many investors and expand their investment asset base. However, there comes a point at which a fund's total asset under management becomes so large as to be unwieldy and cumbersome to manage. Means if a particular mutual fund attracts so large investors, so large asset under management, so it becomes cumbersome or difficult to manage such asset, so it should not be there. This is not desirable. When investing in billions, it becomes increasingly difficult for a fund manager to buy and sell stocks without the size of their transaction shifting the market price. So it cost more than they would ideally wish to pay to acquire a large amount of specific stock. What is the meaning of this? The meaning of this is, suppose a particular mutual fund company bought Infosys stocks, say 1 crore stocks, and suppose Infosys price is 1800 rupees, and the fund manager want to sell 1 crore of stocks of Infosys. As he enters market to sell that 1 crore of Infosys shares, what happens? The supply of stocks increases suddenly and price of that particular stock goes down. So this happens, and when it buys the stocks of Infosys, suppose particular fund manager want to buy 1 crore of shares from the market, then what happens? Suddenly demand increases for that particular stock and the price goes up, and what happens? they have to pay more money for each stock or share. So this happens if the asset under management is so large to manage and it becomes a cumbersome to manage. When investing billions, it becomes increasingly difficult for a fund manager to buy and sell stocks without the size of their transaction shifting the market price. So it costs more than they would ideally wish to pay to acquire a large amount of a specific stocks. So this can be particularly true for funds that seeks undervalued, less popular stocks. Suppose small stocks are there, then what happens if a fund suddenly looks to buy $50 million worth of stocks that is ordinarily not very heavily traded, then the demand pressure injected into the market by the funds buying could drive the stock's price suddenly substantially higher. This would make the stock less of a bargain than it appears when the fund manager evaluated it prior to deciding to add it to the portfolio. The same problem can occur when the fund seeks to sell their stocks or to liquidate a position in a stock. Means if a fund manager want to sell the stocks which are not very heavily traded in the market. Heavily traded means not bought or sold by the investors frequently. So if fund manager want to sell such stocks and liquidate its investment, then what happens, the selling pressure increases in the market and what happens, price goes down. So what happens, uh, the fund may hold so many shares of the stock that when it attempt to sell them, the oversupply may put substantial downward pressure on the stock price, so that although the fund manager intended to sell the shares at $50 or rupees 50 a share, by the time, because of increased oversupply of that particular stock, he is able to fully liquidate or sell the fund's holding of the stock. The average realized sale price is only $47 or rupees 47 a share. Why this happened? Actually, fund manager want to sell the shares at rupees 50, but what happened, due to large number of shares fund manager want to share, the supply in the market increases suddenly and price of that particular stock come down from the 50 to 47 a share, and here the difficulty, to liquidate that particular investment uh, happens. Investor may wish to look for mutual funds that are well capitalized, indicating the fund has successfully drawn the attention of other individual investors and institutions, but has not grown to the point where the size of the fund's total assets makes it difficult for the fund manager to manage efficiently. Problem in managing the fund's asset may arise as the fund's total asset grow beyond the $1 billion level. So here in a nutshell we can say that the too much money or large investment is um, difficult to handle for the fund manager. What are the other characteristic of good mutual fund? The other characteristics are, first is beat inflation, it should be beat inflation. Then expert managers should be there. Then convenience for the investors and investment manager also, there should be convenience means there should not be difficulty for the investors, and all type of convenience. For example, They have to pay less fees, load less documents, the convenience in case of document from the viewpoint of investors. uh, there should be simple process, then the short period of time to liquidate or to withdraw the investment. So these types of convenience is expected from the good mutual fund. Expert managers beat inflation means the mutual fund should perform more than inflation rate. If the mutual fund is performing less than the inflation rate, then all its return on mutual fund actually eaten by the mutual fund, sorry, inflation. So mutual fund rate should be more than inflation rate. Expert manager should be there. Convenience, low cost, we have discussed this point. Then diversification, mutual fund should be diversified, means it should not invest in one type of asset or in one type of sector. Suppose mutual fund which is investing in only one stock or investing in only one sector, it can be risky if that sector goes down or the down uh, slowdown happens in that particular sector. Then liquidity should be there. The mutual fund investor should get the highest liquidity, means the time for converting mutual fund investment into money, or the return which is generated by mutual fund should easily converted into money for the investor. Then higher return potential, the mutual fund, top mutual fund always perform good and it generates higher return, and it should be potential in the longer period of time. It should have the potential to generate higher return for the investors. So mutual fund advisor should suggest such a mutual fund which have the capacity to beat inflation, which have expert manager, convenience, which have low cost, diversification is there in that particular mutual fund scheme. Liquidity, highest liquidity should be there, higher return potential, and last but not least, that is safety and transparency. So mutual fund investors should get the safety. So mutual fund advisor should suggest such a mutual fund which have reputation in the market and which is safe, which is run by the reputed institution, and transparency should be there. SEBI have uh, worked on it, and SEBI have uh, always guided mutual fund industry. AMFI always guided mutual fund industry to keep the transparency in the mutual fund industry. So the result is the mutual fund asset is growing in India so rapidly because of the SEBI and such regulation rules given by SEBI, AMFI, and Government of India, Reserve Bank of India, in case of money market investment by the mutual fund. So concluding remark, we say that selecting mutual fund is always a personal endeavor, personal the skill that should ultimately be guided by the individual's investment goals and plans, their risk tolerance level, and their overall financial situation. However, there are some basic guidelines investors can follow to streamline and simplify the fund selection process and hopefully result in the investors acquiring a profitable portfolio of funds. So, friends, here the investors should keep in mind that the investment should be according to their investment goals, risk tolerance level, overall financial situations. And mutual fund advisor also keep in the mind uh, the goals of investor, goals of his clients, a risk tolerance level of his client, overall financial situation. So mutual fund advisor always study the whole background or the financial condition, the goals, investment goals of investor, to advise uh, in a profitable manner, so that investors get the good returns from scheme. So it is the duty of mutual fund advisor to suggest a good mutual funds. So friends, I hope you got something from this lecture. If you have any questions, queries, you can ask me. You can comment in the comment box. You should write your name and roll number in the comment box. You can call me, you can text me, you can mail me if you have any problem, questions, queries, and I will try to answer that questions. So friends, thanks for watching. See you in the next lecture.